could be a single dwelling, that's an insurance term for you. It could be a duplex, it could be a triplex or a fourplex, but each unit will have its own bathroom facilities and its own kitchen facilities, so there's no shared kitchen and bathroom space. The underwriter is going to be concerned with the age and the condition of that property. So the older a home is, the more relative some of these questions around year built. When was the last time the plumbing was updated? When was the last time the HVAC was updated? Does it have a new roof? And there are some companies that even require, let's just say, for example, any home built prior to 1955 has to have a comprehensive renovation. I'll talk a little bit about what that looks like. The use type, as David indicated, you want to already have in mind what you plan to do with the property. If you plan to be a landlord is usually defined as a unit that has a renter for 12 months or more. And Cassie alluded to some of the challenges of a property manager. So when you find a good tenant, you want to keep them as long as possible. Another use type is the vacant and short-term, the short-term and vacation rentals. And with the likes of your Airbnbs, short-term rentals are really, really popular these days because you can just churn people in, and depending on the city, kind of the amenities and what's going on in the city, the vacation and short-term rental could be a good route for you. Now, there's a distinction between short-term rental and landlord rental from an underwriting standpoint, because there's certain liability with having multiple tenants in a property over a short period of time versus if you have one tenant or one family that occupies that space for an extended period of time. And then a vacant property. Up until recently, there were not very many carriers that were in the vacant space. And I think it's primarily around the idea of a vacant home. Okay, it's acceptable to vandalism, squatters, things of that nature. But really, if a home is secure, it could even, some have boarded up. But if it's secure, there's no access to it, you can get standard carriers to cover a vacant exposure. Now, they would like for the intent to be within a short period of time that it will be occupied, it will be leased, or will be sold. So once again, just be upfront and be clear about what your intent is when you're talking with your agent or talking directly to the carrier. Next thing, which I'm still trying to find on my phone, I'm gonna cheat off of you here. The loss settlement. So depending on which program you go with David, typically you see replacement value or replacement costs and actual cash value. Sometimes the mortgage company will stipulate, hey, this house has to be covered at replacement cost. So I'm gonna give you all a really quick example. Let's just say you purchase a property and it's about 1,000 square feet. Replacement cost is gonna be somewhere, give or take, around $100 per square feet. So if you have to get that policy at replacement cost, then you need $100,000 worth of coverage on that policy. But you only paid $60,000 for it at the market value. So if you go with the $60,000 worth of coverage, then you've got actual cash value. So if a tornado blows through here, like it often does in Central Arkansas, if a tenant has a grease fire in the home and burns your property down, then you probably want replacement costs. And so if I had a property, I would err on the side of replacement costs. A lot of owners like to try to save money by compromising the coverage amount, but I'm gonna talk about some ways you can lower the amount of out-of-pocket expenses for your investment, so out-of-pocket contributions, if you will, on your insurance premium, and not compromise that level of coverage at the top. Sometimes the insurance company will issue a co-insurance penalty if you under-insure your property in a material way. So if you're really trying to save money and you insure the property and it's a loss, then there's a penalty, and so you could potentially not get paid out what you thought you would get paid, which could be a devastating thing for you. Some of the rating factors that go into the premium that you're going to get is, as I mentioned, the age of the property. An older home might even have a surcharge, like pre-1930. There's a company called Hudson Insurance where they'll tack on a surcharge if you have a home that was built pre-1930. The makeup of those homes are a lot different than modern homes, and a loss on that home would, once you account for today's increased labor costs, increased material costs, could really add up. And so they'll cover it, but there's some stipulations that go along with it. Credit is a big thing. Credit's gonna follow you everywhere you go. Your claims history in your current property, whether you're renting or your primary residence. You know, a lot of people like to just use insurance just because they have it, but you really have, once you become an investor, you have to really decide on how much of that risk do you want to retain yourself and how much of that risk do you want to transfer to the insurance company. And so an example of a way that you can retain a little bit more risk and not compromise coverage is in the form of a deductible, a higher deductible. And, you know, the right mix of a deductible, you know, is based on kind of maybe how much liquid cash that you have access to. But it's not uncommon for investors to have properties with deductibles of $5,000 and higher, just depending on the value of that property. So just remember that the deductible has an inverse relationship with the premium. So the higher the deductible, the lower your premium. The lower your deductible, the higher your premiums are going to be. And you have to also ask yourself, if there's a $1,300 problem that goes wrong, a plumbing issue, am I going to really file that claim, or am I going to shell out of pocket, write it off if it's some deductible expense? Because the thing about it is, once you go to that next property and you've got a series of claims you filed on that initial property, then that claim is going to either prevent you from getting coverage in the future, or it's definitely going to get you rated at a higher rate. So it's just definitely a discussion for you to have up front, and even review that on an annual basis. Lawsuits are another thing that you want to kind of protect yourself from, protect your